Hi, this is Corey Chambers in Los Angeles. Your home sold guaranteed or I'll buy it. Thanks for taking a minute to listen in. In a moment, I'll share with you some valuable information about this topic. Downtown Los Angeles real estate update. More sellers than buyers. Real estate news, the Greater Depression of 2020. If you see any properties that are of interest to you, let us know. We will gladly send you a property information packet on any loft, condo, or house. If you have a home to sell, you should know that I will guarantee the sale of your present home at a price acceptable to you, or I'll buy it for cash. This guarantee will allow you to buy your next home without worrying about selling your present home. To find out how much you could sell your home for, call me at 213-880-9910 now. The loft condo property market of downtown L.A. has for decades attracted far more buyers than sellers. That has changed recently. Real estate professionals now report that the number of prospective buyers has dwindled down considerably over the past few years, culminating in a major collapse to nearly zero buyers since February of 2020. As more sellers find that they must sell in order to survive the Greater Depression of 2020, investors and loft lovers will come out to snap up the deals. While Harvard Business Review recently put out an article entitled, "The U.S. is not headed toward a new Great Depression," the facts tell a different story. The article contradicts itself to the point of communicating entirely the opposite. It admits that the virus is, quote, driving a macroeconomic meltdown around the world, end quote, and everyone agrees that there is a pandemic that is equal or larger than the flu-like outbreaks of recent years. But Harvard fails to acknowledge the extreme panic and hysteria linked to pandemic fraud, waste, abuse, and this historic economic shutdown. Harvard does admit that, quote, heavy job losses will likely drive unemployment figures to levels not seen since the Great Depression, end quote, but then fails to acknowledge the fact that job loss speed is already much faster than that of the Great Depression. It fails to acknowledge that we've already experienced a much bigger and faster stock market crash than the crash that precipitated the Great Depression. Harvard admits that government actions are, quote, pushing deficits to levels last seen during World War II, end quote. The article admits, quote, fears and commentary that the crisis is spiraling into either a depression or a debt crisis, end quote. So there's a couple things. One is discount real estate companies are dust. You can click on this link for an example. Also, iBuyers, which have been hot, iBuyers are now imploding. So this Harvard Business Review article asks a question. That question is it too soon for pessimism? That should say, is it too soon for pessimism? Well, for those who don't know how to recognize patterns, maybe it is too soon, until it's too late. But for the authority of downtown residential real estate, actionable market projections are a part of what the LA Loft blog readers have been able to take to the bank for nearly 10 years. The data is in and the patterns are clear to us. The Greater Depression 2020 is visible to us. The only points to argue or ponder about are the details. By some metrics, a modern depression shall be worse, but in other effects, a 2020 depression shall be easier due to overall wealth, technology, and other modern-day resources. So, yes, we're entering into a worse depression, and, of course, in some ways it's not going to be as bad. We know that our current failing economy is already worse by several metrics. The LA Loft blog analysis shows that the most radical economic actions in history have created an enormous stock market crash, unparalleled global paralysis, widespread business industries collapse, historic unemployment explosion, and universal economic collapse of the likes never seen before by mankind. When we're talking about modern day mankind, I'm sure cavemen had it much rough when they would run out of water and food and just die by the thousands. Real estate has already begun a slow, lengthy process of collapse, which shall proceed to substantial, painful levels more before the massive body that we call the real estate sector may bounce back up. Real estate is normally among the largest and most unyielding, the slowest of sectors to crash, and the slowest to recover, because a typical transaction takes from 45 days to 2 years from intent to completion. Because individual home sales are so slow to transact, industry contractions and expansions take an extra long time to play out. So the Harvard Business Review goes off on opinionated tangents, but it ignores the cascading crises, effects, and consequences of pandemics, also ignoring our world history of offshoot crises caused by major economic shocks. The article ignores the root causes and ramifications of food shortages, poverty, starvation, corruption, crime, and social disorder and chaos that have only just begun to reveal their first signs. The Harvard magazine not only ignores long-term effects of the most radical and extreme government fiscal policy in history, it speciously promotes even more extreme socialist-style government meddling, pretending that the federal government can magically get away with infinite QE money printing without eventual runaway inflation or stagflation. The ultimate ignorance comes from disregarding the massive destruction of American small business, the backbone of the middle class. Already under extreme pressure, today's federal and state panic policy is actively wiping out the number one key support for the vital middle class. This is a death knell. With this general decimation of small business that we're seeing right in front of our eyes, the middle class is toast. As for real estate, the medium price range middle class property market is the biggest loser. Economist Nouriel Roubini has his own additional reasons why we're entering into the Greater Depression, a slow-moving train wreck that will take more than 5 years to play out. A collapse in capital spending, long-term negative supply shocks, ongoing COVID-19 and other pandemics and panic, anti-global populism, which naturally leads to escalating trade wars and cyber warfare. Altogether, Roubini specifies 10 deadly Ds that drive 2020's depression: debt, demographics, deflation, debasement, digital disruption, deglobalization, democracy backlash, duopolistic strategic rivalry, digital tech warfare, and deadly disasters such as pandemics and GCC. What's a GCC? Global catastrophic crash. As a group and also individually, we must each personally acknowledge these major obstacles. But for one reason, they carry equally gigantic positive opportunities. Opportunities in cost-cutting, restructuring, launching new business models, streamlining government, empowering small business, medical breakthroughs, helping the poor, launching new media, new financial industries, digital explosion, new manufacturing industries, short selling, gold, blockchain, cryptocurrencies, new security industries, new infrastructure, and new real estate investment opportunities. How's that for some major obstacles turning into gigantic opportunities? Get a free list of the top 10 best investments in downtown Los Angeles. Fill out the online form, the short form, so you can receive free downtown top investment property listings in your email. Here's a picture. There's some good deals coming up, like this one for under $400,000. So thanks for taking a listen and reading about the downtown Los Angeles real estate update with more sellers and buyers and us, the bad and the good of going into the Greater Depression of 2020. As I mentioned earlier, a property information packet is available on any loft, condo, or house, or a property information packet is available, or private preview, I should say, is available. Call 213-880-9910 now. Thanks for listening about this, panic, economic collapse, and the big, major silver lining. I'm Corey Chambers in Los Angeles. Your home sold, guaranteed, or I'll buy it. Thanks again, and you take care. Bye-bye.